My favorite strategy in the market is what I would call sector rotation. So every single year we have stocks that are just hated, industries that are mainly hated, and they underperform. But normally, whenever you have a new year, you have new opportunities, you have new sentiment, and you have new potential leaders. And most of the time, not all the time, but most of the times, the underperformers of 2025s will likely become the outperformers of 2026. And the stocks that are popular right now that everyone wants to own, that everyone is buying, will most likely be the underperformers of the following year. And this is how it normally plays out. So in this video, I'm going to talk about three sectors and three stocks mainly that I believe are extremely hated that could become the outperformers of 2026. I would not be surprised at all. The first one is mainly in the payment processing space. I think this is a hated sector. The software sector, a lot of those software stocks, they got shot like CRM and others. And the last one is healthcare and mainly insurance, which is a stock that I own. So I really hope you enjoy it as always. The first one, very hated stock, is PayPal. PayPal is down 65% over the last 5 years. The sentiment is so bad on PayPal is that it's now trading at 12 times earnings. The company used to trade at 60 times a few years ago. Now it's trading, guys, at 12 times earnings. And the main sentiment is that no one uses PayPal anymore. But the numbers are not saying that. If you look at the active accounts, they have been growing every single quarter, guys. Every single quarter. So if PayPal was dead and no one is using it, why are they growing active accounts by 2 million a quarter? If PayPal was dead, then why would total payment volume be increasing, not consistently, but pretty much every single quarter to 2 quarters? It's been increasing like crazy, around a 15% CAGR since 2019. So is PayPal really dead, or is this something that we just believe? We believe it might be dead, but people are still using it, and we can clearly see it in the numbers. The numbers don't lie. And I believe the potential for a massive change in sentiment in 2026 is huge. But I always joke and I always say that the only thing dying about PayPal is their shares outstanding, because the shares outstanding have been going down a lot. And the company is buying back a lot of stock and they're creating value for long-term shareholders. Now, if you look at the main reason why PayPal has had a really bad year in 2025 is because revenue growth has been declining from 9%, 8%, 5%, 4%, 1%. Now it re-accelerated, but it has been declining a lot. Now, this decline was temporary, and it was due to one of their segments called Braintree. They had a lot of unprofitable contracts with Braintree. The CEO canceled those contracts because he wants to focus on profitable growth. And if he wanted to do that, you're going to have to face a slow declining in growth for a few quarters, which is now over. And now it's expected to re-accelerate in a major way as the company is focusing on profitable growth. And this is a major catalyst for 2026. But if we really look at the company's valuation, and again, I'm doing a quick overview here, this is not a deep dive, but looking at the company's valuation, it's trading at about a 12% free cash flow yield. We can take about 2% off for stock-based compensation. The free cash flow yield is around 10 to 10.5%. So in other words, the company can actually buy 10% of shares outstanding every single year without taking on any debt. And this is not a company that's declining, guys. This is a company that's still growing in revenues 5% and will likely continue to grow. So normally, whenever I'm assessing a potential upside on such stocks with slow growth, I would take in the free cash flow yield, which is around 10% after stock-based compensation, and I would add in the revenue growth, which should be the same as the free cash flow growth if we have no margin expansion. So 5% revenue growth, 10% free cash flow growth. I'm getting around a 15-16% annual return on PayPal. But this is excluding a multiple expansion, and the multiple, again, guys, is trading at 12 times earnings. I could easily see that at 15, 16, 17 times. This is not a low margin business. This is a very high margin business, good balance sheet, buying back stock. So I see much more upside than downside from here. I think 2026 could potentially be the year for PayPal. And I'm looking at buying some call options on the stock, and I'll keep you updated if I decide to do so. The second stock that I believe could outperform in 2026, that's in the software space that's really hated, is Adobe. Adobe is down 27.5%. over the last 5 years. And again, guys, that was a stock that was like the crown jewel of quality investing. All the quality investors loved the stock, and they used to say high margin company, high return on invested capital, 97% recurring revenue. Well, no one's talking about that anymore because Adobe is going down, and I'm going to tell you why it's going down. But the multiple is now trading at 15 and a half times. 15 times forward earnings is unheard of for Adobe. It was trading at 35 times last year, and now it's trading at 15 times, and no one really wants the stock. But the main narrative is that AI is killing Adobe. But if we look at the numbers, again, guys, I'm not saying that. The company used to grow 10% in revenues in December of 2022, and over the last few quarters, it's still growing 10 to 10.5% in revenues, despite AI being here, ChatGPT being here, all the AI models being here. The company is still growing 10% revenues. So is AI killing Adobe? I don't personally think so. But I believe Adobe will likely benefit from AI. They're not sleeping on AI. They mentioned AI 89 times in their investor presentation. They're using AI in their existing portfolio for them to make the portfolio better and to make their products better. And they had a goal of achieving $3.5 billion for fiscal year 2024. I believe right now they're around $5.2 or $5.4 billion. And they have another segment, which is AI first products, where it's 100% based on AI. They have a goal of $250 million of annual run rate as of Q4, but now in Q3, they actually exceeded the $250 million. So they're well ahead of their AI goals. And the company is not sleeping on AI. It would potentially use AI to benefit the product and to improve it in general. But this is another one that's really hated. They're buying back a lot of stock. Shares outstanding are going down in a major way. And again, it's not a dying company. They're still expected to grow in earnings per share 11% in 2025, 12% in 2026, and 12% in 2027. So we're getting a company that has 97% recurring revenue. It's still growing revenues. It's unlikely to be killed by AI, and they have very high margins, very high return on invested capital. They're buying back stock. It's trading at 15 times earnings. It used to trade at a much higher multiple a few months ago. And, we're getting around 12 to 13% earnings per share growth. So to me, Adobe is one of the cheapest stocks in the market, alongside PayPal, maybe even cheaper than PayPal because of the quality of the business. And I think this one could potentially make a major comeback next year in 2026. Now, the final one, which is by far the most hated sector, is insurance. And the stock that I own is UNH, which is United Healthcare. And many of you guys told me, what have you done on the dip? Because you said you was not buying the dip. And I actually did not buy the dip, but I bought call spreads on United Health for June of 2027, and they're up about 74%. So I ended up buying call options on the stock, but I actually haven't bought the dip. But I have some exposure to United Health, and I believe the stock could have a major a major year actually in 2026 for some obvious reasons. But if we really look at 2025, the reason why United Health has gone down so much, and they told you that on their earnings call, they said the primary drivers of UNH earnings shortfall is that our pricing assumptions were well short of our actual medical cost. The current view for 2025 reflects $6.5 billion more in medical costs than we anticipated. So what is the solution in this case? They're going to have to raise prices. It's as simple as that. The company is already putting in price increases for 2026, and in 2026, we should see the benefits of much higher prices, which should offset their medical cost. It's as simple as that. And 2026 will likely be an amazing year. But they said it themselves. They said, turning now to 2026, our pricing strategy is intensely focused on margin recovery and moving back toward our earnings growth target. The earnings growth target is around 13% in earnings per share, and they're trying to move towards that through raising prices, but also exiting some unprofitable markets. And they said, we have made the difficult decision to exit plans that currently serve over 600,000 members. So they're exiting plans, they're improving margins, they're increasing prices. And 2026, we should see the benefits of all of that. And it should likely be an amazing year for United Health, taking into consideration that United Health has $28.5 billion in cash and cash equivalent. And the CEO, which used to be the old CEO of UNH, is well known for for buying back stock. So I'm not surprised if he's buying back stock right now, or if he potentially announces a major buyback program on the earnings call that could cause the stock to potentially make some kind of an explosive move. But I don't really know what's going to happen. But looking at the multiple of UNH, it shows that it's trading at 22 and a half times, but it's not really trading at 22 and a half times. It's trading a little bit closer to 18 times, because this is 22 and a half times like depressed earnings, like the CEO came in and he lowballed guidance. And everything that's currently affecting the company, that's like kitchen sink guidance for $16 for this year. Next year is expected to be a little bit better, about 18.89, which is 16% in EPS growth. I personally believe it will be much higher than 16%, maybe 20 to 25%. But even taking that into consideration, it will be trading around 18 times earnings, which is not bad for a company like UNH. And I believe, again, the upside is great in terms of a potential surprise in earnings growth, more buybacks from the company, the dividend is sustainable, and the sentiment is so bad that a lot of good things could potentially happen. And again, UNH was one of those best compounder stocks to own, the best recession-proof stock to buy. But now, again, not a lot of people want the stock. And to me, I've been interested and I'm still interested, and I'm excited to see what happens on the call. So that's my video for today. PayPal, Adobe, UNH. Hope you enjoyed it. Not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.